momentum traders, to answer your question, here's what happened. So they decide, it finally breaks out. What do? Oh, we're going up this time. So they hang on to the coattails of what is actually a physically driven market. But they get so much bloated open interest. So what you need to do is, of course, in the meantime, the COTs, the same guys that we know that operate the LPMCL pretty much, same footprint in both markets. And what do? Go short against every single one of those guys, knowing, guess what? When we let's go to just about there, margin call. Oh, let's do another one. Bang, out they go. What they've done is they've literally popped the bubble. Thank goodness, good riddance to the whole lot of them, because essentially all that did was put them into the other mode of shorting the market with the same commercials taking the long side of them. So
A widening gap between paper trading and tangible ownership is transforming the gold and silver markets, and Andrew Maguire contends that this division is now more apparent than ever. He states that Western futures exchanges are currently dominated by a limited group of aggressive speculators who hold approximately 85% of the remaining open interest, transforming the market into a momentum-driven environment disconnected from actual supply. Meanwhile, prominent institutions, refiners, producers, industrial consumers, and sovereign purchasers have largely withdrawn, relinquishing a system they consider no longer provides equitable or transparent price discovery. Their transition to physical transactions in Asia has resulted in speculative traders holding overly large and vulnerable positions. According to Maguire, the significant breakthroughs in both metals this year attracted momentum traders into substantial leverage long positions. Anticipating continued upward momentum, commercial banks active in both the COMEX and the LBMA swiftly tempered that optimism by engaging in short positions, leveraging detailed order book insights to identify potential forced liquidations. Once pressure was exerted, successive margin calls eliminated speculative positions across both sides of the market. Nevertheless, despite this artificially induced volatility, Maguire notes that gold remains significantly higher for the year, and silver continues to trade substantially above its previous breakout levels. Evidence, he contends, that tangible accumulation now surpasses the manipulation of paper. Maguire concludes that the conventional Western pricing framework has effectively become emptied out. With the departure of institutional participants and diminishing liquidity, the futures market oligarchy is no longer capable of instigating the substantial price collapses observed in previous cycles. Conversely, China's SGE and other physical-only trading channels necessitate that vendors hold the metal prior to offering it, thereby anchoring prices to tangible supply rather than leverage. In his perspective, this indicates the development of a more stable and tangible market structure, increasingly propelled by actual consumption, declining inventories, and a worldwide transition away from paper-based price regulation. We now present the excerpts from Michael Oliver's interview. Before proceeding, kindly subscribe to our channel and enable the notification chime to receive prompt updates. Thank you, and please enjoy the video.
speculators who decide that, hey, I'll chase momentum in any way. Now, these guys control, momentum traders control pretty much 85% of all the remaining open interest. Most of the open interest from real institutional guys disappeared. I don't want anything to do with that COMEX anymore. There are plenty more physical exchanges, and we know where they are, where they get treated better. If I'm a refiner, a producer, or anything anything where I depend on a real price, why would I have anything to do with this toxic mix of prices that sort of comes together? If I'm take a position, it's visible. There's only a couple of big guys controlling the book. And of course, they're going to take you out. Of course they will. And they do it on a regular basis. So momentum traders, to answer your question, here's what happened. So they decide, it finally breaks out. What do? Oh, we're going up this time. So they hang on to the coattails of what is actually a physically driven market. But they get so much bloated open interest. So all you need to do is, of course, in the meantime, the COTs, the same guys that we know that operate the LPMCL pretty much, same footprint in both markets. And what do? Go short against every single one of those guys, knowing, guess what? When we let's go to just about there, margin call. Oh, let's do another one. Bang, out they go. What they've done is they've literally popped the bubble. Thank goodness, good riddance to the whole lot of them, because essentially all that did was put them into the other mode of shorting the market with, with the same commercials taking the long side of them. So by the time we get this equilibrium that we were just talking about, these guys are pretty much out, long or short. They've just been rinsed of their shorts. So I think what we've done is just establish the next in the series of higher physically supported steps. That's been the process. And my goodness, be great. I mean, what, we're $2,000 up from, we're like $23 higher than the beginning of the year, over $1,500 higher in gold for the beginning of the year. I mean, you only have to step back and look, take the chart chatter out of it. What a good marketplace this is. And it's not being driven by these Western, the Western cartel, basically. And I think they've really, to me, they've blown it. They've lost all the good clients. They've lost all the institutionals. They're now reduced to gaming, a very few, declining open interest really any open interest that's in there is just really mostly speculative. And I think the parameters of that are so contracted, whereas before you could create a $500 waterfall. Sorry, but in this is a lot of physical buyers where you have to, who operate in physical exchanges, as you know, where you have to buy that bar if you want to sell it, as opposed to just putting 4% of skin in the game, 96% leverage position, which is just chasing a price, a dot on the screen. And all we saw was this dot on the screen get squared up, and off we go to a much higher stair step.
Which is what seems to be throwing most of the people that do look at it as a dot on the screen, throwing them off. Is this time different? That would be my next question for you. I've been writing about it all month at my Sprott Money articles. In 1980, silver went from 10 to 48 in about 4 months, and then back to 10 in 2 months. 2011, which you and I recall rather clearly, went from 18 to 48 in about 8 months, and back down into the 20s in 4 months. Well, here we are. We first hit 48 back in early October. Andy, it's 2 months, and we're still, like I said today, 53. It sure feels different.
Oh, completely different. And I think the difference is, again, pretty much what we've just discussed about gold. It's the same in silver. The real actors are gone. And I think this open interest that's in there, it's very limited as to what they can actually rinse out, because we've got physical markets being set in China. We work with the liquidity providers who interact with the Shanghai International Exchange, and really looking at what they're talking about. There's very little. It's interesting because I think what really sums it up, and you and I were talking about backwardations a little while ago. While we have unprecedented backwardations, we've seen $3 backwardations in the past. They get arbitraged one thing and another, but so close to first notice of the largest delivery contract of the year. We're seeing on last Friday 60 cents, $3,000 per contract offside. Now we're still looking at 20, 30 cents. I mean, ludicrous into first notice. Through options expiry into first notice, which is actually supposed to be tomorrow, but it's actually happening today because it's
goes off the board on Wednesday and trades first notice on Friday. Yep, end of the month.
Exactly. So, so what it tells us, what it screams at us is, hey, you can't have a backwardation coming into a delivery month where where it's not telegraphing to you, it's mispriced, severely mispriced. And I think the reason for that, Craig, is because the LPMCL's CME relationship, where they've got a footprint in both markets, haven't they? Um, the liquidity spigot is broken. It's completely broken. They don't have liquidity anymore to be able to pull this back. And what you got, like 4 billion in SLV shorts, and some
Yeah.
of that, yeah, there's going to be some legitimate hedging in there, but 4 billion odd in short positions. That means that if I own an SLV share, it isn't there necessarily. Not if everyone wants it at the same time. And so I think it is screaming. I mean, to be honest, I think these guys are turning in on themselves.
Gold persists in drawing significant inflows from sovereign purchasers, institutional reallocations, and investors seeking refuge amid declining global bond markets. Maguire emphasizes a significant change in public sentiment. Large institutions are now publicly contemplating portfolio allocations to gold of 20 to 25%, a level that would have been inconceivable only a few years prior. Because most U.S. funds are unable to directly hold physical metals, they are increasingly investing in ETFs, establishing a more resilient form of demand that is less susceptible to fluctuations caused by routine paper market volatility. As allocations continue to increase consistently and initial indications of backwardation emerge in forthcoming gold delivery months, the market is positioning itself for a possible long-term revaluation prompted by diminishing physical supply. Looking ahead to 2026, Maguire anticipates that Western paper markets are approaching a structural stress threshold, beyond which leverage may become unsustainable. Persistent backwardation, expanding physical premiums, and ongoing liquidity shifting toward Asian exchanges may ultimately threaten the dominance of Western benchmarks entirely. In this context, substantive price discovery would transition to exchanges where ownership of the metal must be established prior to sale, a framework considerably less susceptible to artificial influence. The sole factors that could disrupt this trajectory would be an abrupt decline in physical demand or an unforeseen reversal in sovereign accumulation. Both seem improbable given the escalating geopolitical tensions and the increasing concerns over global debt.
LPMCL are just the four banks that basically control the cartel, basically. And I think their liquidity is completely blown to smithereens.
Mm.
All the institutional guys, as we've just said, they've exited. And now you can still access, as an institutional trader, I can then go in and tag the SGEI gold corridor, which is opening up big time. Can access an increasing number of vaults, gold and silver that can be traded. With a real physical price that is much more stable than this unbelievable
Right.
paper toxic mix that is thrown in. And it only serves. And I think the reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. And if I'm a producer or as a refiner or something, why would I want a price that's so volatile? I just want to know supply demand. People are owning a bar before it's put for sale. You have to own it before you can sell it, which tells me that if you put it up for sale, that's a proper price. I don't care what that price is. It's the proper price.
Right.
It's not a COMEX derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. That is how markets are supposed to trade. And we've been gaslighted, or many people have been gaslighted into believing that this huge COMEX volatility is the market. It just
Right.
amazes me.
Right. Right. And if we've all been waiting for that to change, that leverage that they apply gets stretched to a breaking point. We don't know what it is. All this talk about how much free float there is in London backing those
Hmm.
games. And you always used to describe it to me that, they just take a forklift and move silver from one side of the vault to the other, right?
And they won't sell it. They won't sell it. They literally will not sell it. And they don't. If you remember years ago, we used to talk about, we have a big client. We go to UBS and we say, can we have X amount? They say, no, that's
Yeah.
all you can have. Hang on, no, we will pay you for it. It's just like, just give us a price. No, you can't have it. And it's like, okay. So then it tells us what the game is. The game is,
Right.
make sure, if I'm a seller, I'm UBS or JP Morgan, I've got silver at this price. I don't want to sell anybody, but I've got to look like I'm making a market. So make sure that Samsung, Nokia, and all these people get their silver, because if they don't get it in time, they're going to come to the market and just buy everything that they can, and the price is going to spike higher. Their derivative positions that relate to these. The reason they're not selling is because there's derivative positions attached to these physical bars, multi-leveraged. You know all about this. You've been talking about it for years with your clients, and it's like, well, of course, it's mispriced. So I think they can't actually. They've lost the plot. There is literally nothing they can do. They might want to do it, but there comes a point now where, it's just really interesting. I met a guy just a short while ago who's just written a book, I think 1,000 Reasons to Buy Silver. And he's saying, do you know that it takes 20 tons of silver to make 1 gigabyte in photovoltaics? Say 20 tons of silver to make 1 gigabyte. And he said, thousands of gigabytes are required. He said, so there's a supply shortage.
Wow.
And now we've got another 500,000 ounces a year of stuff that doesn't include AI. I mean, where's this silver going to come from?
Right.
These guys have dug a hole for themselves. It's a multi-billion-dollar hole. There isn't the silver there to fix that hole. So the market's just simply going to run off with the SGEs are going to set the price. So if you have a mispriced position and it just happens to be a little bit backwardated at the moment, what happens when it is $3, $5, $10 difference and permanent? What happens to the COMEX then? Yeah, because the January contract is already at par. Shouldn't be. I mean, so you've got backwardations in December, although the next liquid contract is March. But when you look at silver, sorry. So, but then if you look at January, that's already in
Teetering.
technical backwardation.
Mm-hmm.
So it is happening. It is happening already. And now we're talking about 2026, and they're not even done. I think this morning I looked, there was still, I think, 2,000 odd tons of silver warrants floating around in there. And the thing is, there's a lot of people that I know and who are saying, well, yeah, we bought and we're taking delivery. We are taking delivery.
Mm-hmm.
Why? Because it's the only source of physical that I can get to my limit, to my actual limit. I can buy that. And so if that's the only source of physical, going to be banging on that back door, out it goes. So how can that possibly be? And that's mispriced. It's so grossly mispriced. And furthermore, even if it was more expensive, people would still be lining up to get it because there's not enough on offer to meet all the demand. So it is a toxic mix. And as I say, that's why I think these guys are like rats fighting in a sack.
If these developments escalate, silver is poised to experience one of the most significant structural transformations in its modern history. With physical inventories already constrained and industrial demand increasing across sectors such as energy storage, solar, and advanced electronics, the metal may enter a phase in which availability becomes the primary factor influencing price, rather than market sentiment or futures trading. As off-exchange purchasing increases and an increasing number of participants demand verifiable bars rather than paper substitutes, the disparity between actual scarcity in the real world and exchange-based quotations could significantly expand. This could trigger a long-anticipated revaluation phase in which silver breaks free from decades of suppression, advancing not through transient surges but via persistent demand driven by manufacturing requirements, strategic accumulation, and declining above-ground inventories. If global supply channels remain under pressure and emerging markets continue to amass reserves, silver could shift from being an undervalued commodity to one of the most sought-after resources of the decade. What is your perspective on this transition? If you found this analysis valuable, please consider liking the video, sharing it with others, and subscribing to ensure you do not miss any future significant updates. Thank you for your attention.